For decades, the Indian middle-class retirement dream has followed a single, rigid path: accumulate a target corpus of exactly 1 crore rupees, and upon turning 60, park it in conservative, fixed-return instruments to generate a steady yield. Relying on this static model today creates a mathematical collision that exhausts the corpus decades earlier than intended. To find out exactly where these popular plans break down, we ran a severe 40-year financial stress test on a standard 1 crore rupees portfolio, exposing the structural vulnerabilities that traditional calculators ignore. Managing wealth after your active income stops is an exercise in multi-decade risk management. The first relentless pressure on your corpus is inflation. India's historical long-term average hovers around 6%. That compounding math means a lifestyle costing 1 lakh rupees a month today will require nearly 1.8 lakh rupees to maintain in just 10 years. But this graph reveals the true danger. While general inflation tracks at 6%, medical inflation in private Indian healthcare facilities is surging at an alarming 14% annually. A standard procedure that costs 5 lakh today will predictably escalate to 27 lakh within 15 years. This collides directly with longevity risk. Traditional models assume a life expectancy of 75 years, but affluent, educated populations frequently live into their late 80s and 90s. By definition, anchoring your financial plan to a median life expectancy guarantees a 50% failure rate. When you pair an extended lifespan with double-digit medical inflation, you create the exact economic conditions required to completely outlive your accumulated wealth. Let's test the default choice for conservative Indian investors. They
Fixed
provide
deposits.
undeniable stability and shelter from market volatility. This simulation table tracked a 1 crore rupee fixed deposit against rising living costs. Because the nominal interest payout remains static, it fails the inflation test. To maintain your standard of living, you are forced to withdraw from the principal corpus. By age 75, the entire account is completely exhausted. Immediate life annuities attempt to solve this by guaranteeing an income stream for life. While the nominal payout on this table stays a consistent 7.8 lakh rupees year after year, the real purchasing power of that money rapidly shrinks. By age 80, the payout is worth less than half its original value. Prioritizing absolute nominal safety in the early years of retirement ensures total failure in real, inflation-adjusted purchasing power later in life. To introduce market-linked growth, the modern financial influencer community frequently recommends a systematic withdrawal plan, or SWP, allocating 65% to equity and 35% to debt. This introduces a specific vulnerability called sequence of returns risk, where the survival of your portfolio depends on the market's performance in the first few years of withdrawal. Rebuilt a 7-year Crucible stress test chart to demonstrate this. Imagine you retire at age 60, and the market immediately drops 30%, followed by 3 stagnant years of 0% returns. A standard SWP forces you to withdraw a rigid rupee amount to fund your life. During this crash, you are forced to liquidate a massive number of equity units at deeply depressed valuations. Your portfolio begins to cannibalize itself, hitting zero by age 83. Without a structural defense mechanism, selling undervalued shares permanently damages the portfolio's compounding engine. Any subsequent market recovery will compound on a much smaller capital base. Surviving severe market volatility requires replacing rigid assumptions with a structurally superior solution, a dynamic equity-biased framework that utilizes a highly aggressive baseline of 75% equity and 25% debt. The first mechanical rule of this framework abandons fixed withdrawals. Instead, we use an NAV-linked variable payout, set strictly at 6% of the portfolio's prevailing net asset value. By linking your income directly to the portfolio's performance, you mathematically prevent over-withdrawing during a crash. The second rule is the debt stability buffer, represented by these adjacent tanks. During a severe downturn, equity is quarantined completely. Required income is funded entirely by the 25% debt bucket, preventing forced liquidation of undervalued equity and preserving maximum shares. Because the withdrawal is tied to market performance, a crash early in retirement results in a lower absolute rupee payout. Accepting temporary income volatility is the strategic sacrifice required to guarantee permanent purchasing power protection. Watch what happens when we run this dynamic framework through that exact same 7-year stress test chart. The corpus takes an initial dip, But because withdrawals were funded by the debt buffer, the equity base remains completely intact. When the market enters its recovery phase in year 5, the portfolio rapidly scales upward. This comparison matrix shows the ultimate result. To survive a 40-year retirement, the traditional SWP requires an initial break-even corpus of 1.6 crore rupees and still depletes to zero. The dynamic 75-25 framework requires only the baseline 1 crore rupees, survives the crashes, and compounds into a massive 14.4 crore legacy by age 100. Sustainable retirement planning requires a dynamic system engineered to absorb economic volatility. To see how your own numbers perform under this exact stress test, you can download our dynamic retirement spreadsheet or book a comprehensive portfolio review using the links below.